On today's hot sheet, I'm discussing life milestones that are reshaping home ownership. You may have seen these trends, new rental reports from Redfin and Realtor.com and mortgage applications. Today's Wednesday, April 16th, 2025, and the hot sheet starts right now. Welcome to the Hot Sheet, the industry's only daily live news show on the internet, brought to you exclusively by BAM. The Hot Sheet covers exactly what you need to know to be the knowledge broker in your marketplace and to understand the real estate industry in a 24-hour news cycle. We see that the most effective agents, they have their finger on the pulse of all these issues so they can deliver value to their clients and educate folks with data. So we've got a bunch of stuff to cover today. I'm Tom Toole, filling in for Byron Lazime while he's smoking cigars and drinking high-quality alcohol down in the Virgin Islands. So I hope he's having a great vacation with his family. The first thing we're going to talk about are delayed life milestones that are reshaping home ownership. And if you think about this, I've seen this happen for a very long time where family formation is changing. People are getting married later in life. They are having kids later, and it's changed the real estate cycles. And this is stuff not only that it's important to identify when talking to folks that might fit into that bucket, also when talking to home sellers, because the more you need to know, what's up, Jeff? Thanks for the shout out there. The more you know about exactly who the buyer of their home is, the more likely you are to get the listing and be able to identify a strategy that's going to find that particular buyer. So the John Burns Consulting, they report that U.S. births fell to 3.6 million in 2024. That's a 40-year low. And despite the population growing by 108 million since 1983, we're at this 40-year low now. And delayed life milestones, what it means for real estate is that the first-time home buyer, the average age has gone up to 38 years old. That's pretty bananas. I mean, even 10, 15 years ago, it was in the mid to late 20s. And 72% of renters are age 30 or older, which is also a big jump. So there's a couple things to look at here. And I guess, Haley, if we can put up that first chart that shows the U.S. Annual births match that kind of go through this cycle. Now, we saw something similar happen in 1980. So, I mean, obviously, there's a cycle of population growth here. And what I really want to show is so you can see what that looks like. But if we can go to the next chart, the shifts in family trends along with delayed adult milestones. And this is exactly what I'm talking about here. So if you look at, what was happening in the 80s, 83% of people were living on their own. That's down to 70%. You see people having roommates and using that to offset costs, whether they're buying or renting a home. People getting married. Look at the age of someone getting married. The percentage of U.S. 30-year-olds reaching that milestone, that went from 78% in 1984 down to 48%. That is a significant drop. And typically marriage is one of those Ds, one of those things that drives home ownership, all the motivators, death, divorce, diamonds, right? That's marriage. That's what we're talking about there. Diapers, having kids. That usually happens after people get married, sometimes before now. And look at home ownership. It declined from 47% in 1984 to 33% in 2024. So this is the exact milestone that I'm talking about here. You can kill the chart. And, we saw that there's a decline in motherhood. Women born in 1990, 63% of them had one child by age 34. Well, guess what? In women born in 1950, 80% had a child by 34. So this is exactly what we're talking about here. And the age of first-time mothers today is around 30. In the 70s and 80s, it was like early to mid-20s. So that's exactly what we're talking about. And family size comparison, the average woman born in 1950 had 2.24 children by age 34. Now it's 2.09 children. So obviously you can't have 900ths of a kid, but you get the point that the numbers are declining here. And these delayed life milestones, they have an impact on housing. And each generation since baby boomers have hit life milestones later than the previous one. So when you look at that chart, it's really important to understand that. And this affects housing because it's going to affect who the buyers are, who's purchasing properties, who's transacting. So that's what you really need to know here. If you look at the impact on housing, the youth population has peaked for people that are under 18. What we've also seen happen is that the projected is to decline by 2.4 million by 2034. That means there's going to be fewer bedrooms needed in homes. That means there's going to be slower growth in future renters and home buyers. So the first-time buyer is going to actually slow down a little bit instead of speed up. And despite fewer kids, all major home buyer age groups are going to grow over the next decade due to past birth trends. So if we can go to the chart here, Haley, that talks about delayed home ownership, and it's right in school there. 72% of the U.S. renter population is 30 or older. That's an all-time high. That really demonstrates what we're talking about here with these changes in population, because it's going to be very different in terms of what's going on and how things are happening. If you look at the next chart, it's the rental report from Realtor.com, and it talks about rents declining again. So even though we're seeing these, actually, I got ahead of myself here. Let's cut that back, Haley. I'm sorry. So the rental demand is going to rise, right? Because people, they don't need to buy a home, and it hasn't been a priority for a lot of folks. 72% of U.S. Renters are now 30 or older. That's a record high. And there's also a shift in housing preferences. We've seen a lot of people say they want something more efficient. They want smaller homes. Maybe they've got these delayed milestones. This is stuff that's going to impact not only probably the luxury market at some level, but also the single family home market. So it's really important to understand exactly how this is going to work. Now we can get to the Realtor.com rental report because I'm a big believer this John Burns Consulting report plays into this right away. So the Realtor.com, the 2025 rent report, it shows the median asking rent in all 50 U.S. metros that are ranked the largest fell down to $1,694. And that's down $65 from the 2022 peak. Now, it may not sound like a lot, $65. I mean, you're looking at a significant percentage here. It's about 4% drop roughly on that number. It's still 20.2% higher than pre-pandemic numbers in March 2019. So rent's still very high. Don't get me wrong. And now you've got these tariffs on building materials. They could reverse these declines a little bit, especially in fast-growing markets like Milwaukee, Memphis, and Oklahoma City. So if you want to look at this report here, this is the rent decline. We can go back to the chart. Sorry about that, Haley. It's a March 2025 rental report. And you can see the decline here. So median rent year over year, it's really dropped. Now, median rent has held, but the increases year over year have dropped. And there's a couple reasons for that. One is household formations changing. We talked about that. Secondly, what we're also seeing is that, people are prioritizing, hey, maybe we need to go buy a property. And then on top of that, you've got more rental units being built. So we can kill that chart for now. And when you look at these numbers here in different regions, there's going to be some significant rental growth from pre-pandemic to now. So the first is the Northeast. Pittsburgh was the leader, 47.9% increase. That's another growing city. A lot of these Midwestern cities saw a lot of people flock to them during the pandemic. The leader in the South is Tampa, Florida, up 45.7%. Indianapolis is in the Midwest, 34%. And Sacramento, 30.6%. That's the highest in the West. So we're seeing that there's some significant growth rates that are happening there. The big question a lot of people have when it comes to rent, and this affects the resale market as well, is tariffs and construction impacts, right? So newly announced 25% tariffs on imported steel and aluminum, they could have a couple impacts here, because a lot of people are asking, like, what's going on with these, all of these tariffs? How's it going to impact things? We know the National Association of Home Builders, they predicted a $9,200 increase on the average new home build. Now, what this could increase, and this affects rent because there's a lot of rental units being built. We're seeing that right in my neck of the woods in very high-end neighborhoods, luxury rentals being built in what were formerly retail spaces. It could be an increase in construction costs, a delay or cancellation of multifamily projects in general, and it could push these rental prices higher due to limited supply. And there's a couple markets that have seen very quick growth when it comes to multifamily permits. You've got Milwaukee, Oklahoma City, Memphis, Cleveland, Columbus, Atlanta, Cincinnati, Birmingham, San Diego. Even markets with declining permits could see higher rents. And when we see these year-over-year increases in rent, there's an opportunity for agents to talk about, hey, I don't know if this would be for you, have you ever thought about buying a home, and show the cost benefit of buying a property versus renting a property? What's it actually going to cost you? And remember, renting, you're paying a mortgage, you're just paying somebody else's mortgage. That's the kind of language you want to use when people talk about this. We've seen a number of metro markets have large median rent increases. New York, Newark, Jersey City, Kansas City, Missouri, the Washington, D.C. area. So Kansas City and Newark, New York, Jersey City, they both saw 5.3 and 5.6% respectively numbers in terms of growth in median rentals. DC's up 2.6%, Detroit 2.4%, San Jose 2%, Oklahoma City 1.8%. So we're seeing the top 10. When you get to number 10, which is Tampa, it's only a 0.2% increase. So you can see rentals are relatively flat, and then you've got a lot of places declining that are Denver, San Diego, Birmingham, Alabama, Austin, Phoenix, Cleveland. The list goes on. And when you look at the Redfin report, I think, and this is going to be where it's really important to understand your local numbers. The home ownership, the number to own a home, it requires 82% more income than renting. So rents are flat. Obviously, rates have gone up. Prices have gone up. Thank you, Haley. This is something that you're going to need to, kind of talk about with folks. And for the well-qualified people, there's tax benefits. There's a lot of reasons you want to buy a home. For some of these people, they're not going to be able to. And that's why we've got such an affordability problem right now. The average buyers need on average $116,633 a year in income. Renters need $64,000. So, people getting married, again, this is why you want to look at the motivating factors. We talked about this yesterday on the hot sheet. That's exactly what you want to be looking at. It's an 81.8% gap. Okay. So that's up from 73.1% last year, 54.5% in 2023, and 17.3% in 2021. So the gap is widening. What's the reasoning behind that? What are some of these economic factors that are going on? And then we're going to talk about mortgage applications, obviously. So home prices rising is number one. They're up 4.5% year over year as of February 2025. The 30-year mortgage is hovering around high 6-7%. That's the rates we're seeing get quoted today. Median asking rent has not increased much. It's only up 0.2% year over year. So people that aren't making a lot of money, it's a lot more affordable for them. Rent growth has slowed because of all the new apartment construction. Instead of building new homes, which is what we should be doing, people are building apartments. And I get it from a business model perspective. It just doesn't make sense from a housing affordability perspective. That's why you want to see hopefully some programs from the government to incentivize builders here. And for sale inventory is tight, which causes bidding wars. It causes price growth. It causes a lot of things that is not great for somebody already on the edge of affordability. So Redfin, they defined affordability. And Redfin considers a home that's going to be affordable if the monthly mortgage cost stays under 30% of the household income. And, we know that debt to income ratios, typically they're looking at like 50% for approvals and on top of what other debts that you have. So that number makes sense. And this report, what they're showing here, it's a rolling 3-month period. So it's got the latest data through the end of February. And as always, we're seeing cities where the gap's widening and cities where the gap is shrinking. So where it's becoming less affordable, and we're seeing big jumps in home buying premiums. No surprise here. You're going to get all these cities. Salt Lake City, Utah. Apparently, that's the place to be. Income needed to buy a home is $140,000. That's up 134% more than renting. Okay, and that's up from 106% from the previous year. Home prices are up 4.3%, but rents are down 7.8%. Austin, Texas, another hot spot, another exciting market. Home buying requires 143% more income. That's up 24.6 points. Rents dropped 10.1%. So, that's one of the things that we see happening here is you're not only seeing prices go up, but rents are dropping. San Diego's another one. It's up to 127% more income. That's up 21.7 points. Thank you for highlighting all that there, Haley. Home prices are up, but rents went down 5.7%. New York City up 20.7 points. Now, this is where it's only 76%. So the gap's widening here, but it's 76% more. Home prices are up 8.6%, and rents are down 4.5%. And then you got LA is up 20.7 points. So no surprise there. Those are all very sexy markets that see a lot of growth. The cities where the gap is shrinking, a little different, right? You got Cincinnati, Ohio, Providence, Rhode Island. Surprised that Washington, D.C.'s in there. Baltimore, Maryland, Louisville, Kentucky, Sacramento, California. They're not those places where you have these, you see these peaks and valleys. The markets we just talked about, they're the more volatile markets, right? I'm in the greater Philadelphia area. We have a very stable market. Where's Philly coming in there? We're right in the middle. So, that speaks to that. And a lot of these are, for the most part, Northeast or like Midwest, but close to the Northeast markets, with the exception of Sacramento there. So the highest home buying premiums, San Jose, San Francisco, no surprise there. They got that tech bubble happening. Lowest home buying premiums, Pittsburgh, Cleveland, Detroit, Cincinnati, and Philadelphia at 40.9%. Go Birds. Love seeing that. So this is going to be something you need to get educated about, because some people, it's going to make more sense for them to rent. And the goal of an agent is to communicate to your clients with data. So if you can break down, here's what it's going to cost you to buy a home. Here's what it's going to cost you to rent a home. Some people aren't going to be able to afford it, so you're not even going to have the conversation. But that rent versus buy, it's not even an objection. It's just what people say, what they're thinking about. It's a decision. You got to, one, get clear on their motivation to buy a home in the first place. And then can you articulate what it's going to cost to rent versus buying, right? How much equity are they going to lose? What is it going to cost them if they wait, right? And then maybe, rates go up, or rates are projected to go down. But you got to get well versed in the financials. Math can be your friend here. So the last topic we got is mortgage applications. So according to the Calculated Risk blog, reporting on data from the Mortgage Bankers Association, mortgage applications fell 8.5% last week, and purchase applications were down 5%. Refinance activity was down 12%. Armshare jumped, that's adjustable rate mortgages, that jumped 9.6%, the highest since November of 2023. So we're seeing that applications dropped, right? And when you look at the refinance numbers, that's no surprise. Rates jumped up a little bit. They're coming in around 7%. So, if you look at the overall market activity, the composite index, it's seasonally adjusted, again, down 8.5% from 1 week earlier. The unadjusted is down 8%. So we're seeing that activity dropped a little bit. The purchase index is down 5% from the previous week. Now, there's a lot of things happening. One, you've got a holiday coming up. I think you can't ignore that, especially in the Northeast. A lot of people are taking vacations. They're on spring break. That's going to be regional. That's going to be local for whatever's going on in your market. What we're also seeing is that rates spiked up. So that obviously brings activity down. And the typical loan terms that we're seeing, the 30-year fixed rate for conforming loan balances, that's less than $806,000, increased to 6.81% over the past week. So, and I'm seeing rate quotes above 7 now this week. So you have to look at your local lenders and understand what they're offering. Points decreased to 0.62 from 0.63. So really no movement there. So what we're seeing is that the market pulled back a little bit this past week. That usually happens when rates go up. That doesn't mean stop working, ladies and fellas. That means you got to maybe work a little harder and find the people that are motivated, that have a reason to transact. I cannot stress this enough. You've heard me say it the past 2 days hosting this show. That's exactly what you need to be doing. The MBA's SVP and chief economist, the Mortgage Bankers Association. I'm going to read you this quote, and then we'll talk about what this means for the market. Mortgage rates moved 20 basis points higher last week, abruptly slowing the pace of mortgage application activity, with refinance volume dropping 12% and purchase volume dropped 5% from the week. Purchase volume remains about 13% ahead of last year's level, but economic uncertainty, this is the number one objection right now, by the way. I'm going to talk to you about how to handle that in a second. And the volatility in rates is likely to make at least some prospective buyers more hesitant to move forward with a purchase. One notable change last week was the full percentage points increase in the ARM share, adjustable rate mortgages. Given the jump in rates, more borrowers are opting for the lower initial rates that come from an ARM, with initial fixed rates closer to 6% in our survey. The ARM share at 9.6% was the highest since November 2023. Before I finish the quote, the reason people are going with ARMs is because they want the lower rate. That's a direct effect of rates jumping up a little bit. And this reflects share of units. On a dollar basis, almost a quarter of the application volume last week was for ARMs, as borrowers with larger loans are even more likely to opt for an ARM because they're going to try to refinance later. That's what happens, right? These people don't want to stop their transactions. So this is no surprise here. And there's two things we're hearing a lot of right now. One is that people are nervous about the economy or they're nervous about the tariffs. Those are the two buckets. It's all kind of relative. So in order to handle that, you're going to hear this on prospecting calls. You're going to hear this talking to consumers. And a lot of people don't even know what this stuff means. So the best way to handle the nerves around the economy, the nerves around tariffs, is asking one question. Hey, totally get it. There's a lot of uncertainty in the market right now. Just out of curiosity, tell me exactly what's making you nervous about the direction of the economy right now. Then stop talking, shut up, listen. And based on how they answer that, you can give them some of this data here that we went over. You can give them some of the data that's being put out on a regular basis if you want these slides and that sort of thing. And when you listen and then ask follow-up questions like, hey, totally get it. That makes sense. Here's what I'm seeing in the market right now. So tell me a little bit more about the new home you're trying to find. Tell me a little bit more about what got you excited about making a move in the first place. Tell me a little bit more about why you want to get your home on the market before the summer. These questions, they get back to motivation. So you want to acknowledge it, ask exactly what's making them nervous, and then use charts like this and like the ones we used yesterday to talk about where pricing's going, what's going on with mortgage rates. There may be some opportunity here when mortgage applications come down. That's an opportunity for buyers. That's something you want to talk about. Hey, there's a little less competition in the market this week. I don't know if this would be for you, but I got a couple properties that hit a lot of your boxes that you told me you'd be interested in a couple weeks ago. Why don't we go take a look at them? What do we have to lose? That's the kind of language that is going to win in this kind of market because there is a lot of uncertainty. And you've got to be able to communicate with your clients with data. So if you need access to these charts and the slides that we reviewed today, and they review every day on the hot sheet, sign up for the BAMX school account. This is where you get access for all the downloads, right? All the courses, the biweekly masterminds. You got some classes with me in there about objection handling and the BAMX community. The link is in the description to sign up. Click it below because that's how you're going to win in this market, right? It's a tough market out there right now. It's competitive. Jason, if I knew that answer, we'd be doing it. Now, there are some banks that have that had the 40 years been floated out there, but obviously, some people don't want to, get involved in that kind of commitment. But there's, affordability is going to be what it is. And Jason, for some perspective, the average 30-year fixed rate since they started recording these is 7.74%. So we're actually still less than the average all time. We're just coming off those low levels that has skewed everyone's perspective. So get educated. You got the message here. Focus on motivation. Haley, let's pull up the 10-year here and see how we're doing today. So we got 4.3. I saw it just go down to 4.337 about a minute ago. It changed as I was, there we go. So it's up, 0.014. So not a huge change from where it was from the previous year or from yesterday, excuse me. And where we're seeing mortgage rates today on Mortgage News Daily is we're seeing around, what do we got here? 6.88%. So this is where we are, ladies and fellas. The mortgage rate is not going to be the reason people transact. The reason they transact is because they have a need. Keep that in mind. We'll see you soon on the hot sheet. Let's go talk to some people and help them.